Let's talk about property tax. Remember back when we talked about mortgages, we said that when we look up a monthly payment in the table, that is the principal plus interest on the loan. But it does not include taxes and insurance. We call that the PITI payment. Principal, interest, taxes, insurance, that's everything. And what happens is the loan company generally charges us a little more than 1/12 of a year's taxes and insurance. We add that onto our payment. They keep it in an account called an escrow account. They collect it for us. The tax organization and the insurance company send the bill to the mortgage company, and they pay it for us with money that we've been giving them all year. So it's basically a forced savings account where we don't earn any interest. And that's what we have to do if we want to borrow $100,000 from somebody. They don't want to take a chance on us allowing the taxes or the insurance to not get paid. So let's look at how property tax works. Generally, we talk about assessing property. Property will have an assessed value, and that assessed value will be a percentage of the market value. So let's say we have a market value on this house of $130,000. And let's say for tax purposes, we are going to say the assessment rate, there's an assessment rate, and we'll talk about how to figure that out in a minute. Let's say the assessment rate is 30%. We multiply the assessment rate times the market value, and that gives us the assessed value of that property. Now, what is the assessed value of the property? It's the value of the property for tax purposes only. If you've ever looked at your car assessment, when you go down to the revenue office every year, before you can get your license plate, you have to get assessed, right? And they say, here's the year car, here's the model, here's the make, here's the book value, and here's the assessed value. And it's way less than what the car is worth. But that's what they tax us on because it makes us feel better. It makes us feel like we're paying less tax because, oh wow, they're only taxing me on $1,000 and this car is worth $6,000. Well, all you have to do is raise the rate to get the same amount of tax. So what do we get here? Everybody get $39,000? So that would be the assessed value of this home. Now let's say the assessment rate, the tax rate. The assessment rate is something that's just set by law or by policy, but the actual property tax rate, is figured by how much we need in our budget, and we divide it by how much assessed property there is. But let's say we already know that. Let's say the assessed rate is 0.0512. All right, 0.0512. That means we're paying a little over 5% property tax, not on the whole amount, but simply on the assessed value. So we would multiply the property tax rate. Here's our property tax rate. Here's assessed value. Here's the assessment rate. The property tax rate is the 0.512. And if we multiply that times our assessed value, we should get about 1/20th of that, somewhere around $2,000. 1996.80. Does that sound right to everybody? That would be our property tax for that home. And basically, if we divide that by 12, that's going to increase our payment by $180 a month, something like that. And that has to be paid even after we pay off the loan on the house. There's still taxes on it. And a lot of people, a lot of retired people, have gotten really hurt by that because they bought their home in a place where the property values were reasonable, and now it has developed around them, and their home is worth way more than they paid for it, way more than they could afford to buy it for now. Fortunately, they don't have a mortgage payment, but they still have to pay the taxes on it, and the taxes are based on the market value of your home. So that can be a problem in terms of making those payments.